Good morning, everyone, and welcome to Economic Alliance Snohomish County's 2025 Economic Forecast Coffee Chat. I'm Ray Stephenson, President and CEO of the Economic Alliance, and I'm thrilled to be hosting today's discussion. Each year, we gather experts to provide insights into the economic trends shaping our region, and this year is no exception. Our economy is constantly evolving, influenced by national and global factors, industry shifts, and emerging opportunities. Today, we'll dive into these topics with our esteemed speakers. Joining us today is Christina Perkich, Vice President and Regional Executive at the Federal Reserve Bank in San Francisco. Welcome.
Thank you, Ray. Happy to be.
As well, James McCafferty and Hart Hodges from Western Washington University Center for Economic and Business Research. Welcome, gentlemen.
Good to be here.
Thank you, Ray.
Their expertise will help us understand what lies ahead for businesses, workforce development, and economic resiliency in Snohomish County and beyond. Before we begin, I'd like to thank our sponsor, Herald Media, for supporting this conversation. We encourage you to ask questions in the chat throughout the session, and we'll address as many as possible during our discussion. Now let's get started. We'll begin with a presentation from Christina, who will discuss the role of SF, Fed, and national regional economic trends and their implications for business in our area. Christina, the floor is yours.
Thank you, Ray. I'm really happy to be here this morning. And hopefully you walk away this morning having a better sense of the work that we do at the Federal Reserve Bank of San Francisco and understand why our work in the community is so important. With that, so we are the U.S. Central Bank. Our role is to foster stability, integrity, and efficiency in our nation's monetary, financial, and payments system. We have essentially three core functions. You may know us. Our work is, interest rates is what we're, very much known for. We also work to strengthen our financial institutions to ensure, obviously, that, our banks are safe and sound, and also to enhance the payment systems, which means, when you're at the bank machine, ATM, and you're withdrawing money that you can get your currency. And we here in San Francisco Fed with the Renton branch where I'm located this morning, we are a cash processing center, and I'll share a little bit more about what we do here with that work. So our goal is very simple. And if there is anything, a headline you can remember from this morning, it's we're building an economy that works for all of us. And we do that through our dual mandate. So what is this dual mandate? It's essentially two items here: maximum employment and price stability. What that means essentially is everyone who wants a job can find a job, and that the dollar continues to hold its value. And we'll get into a little bit more about that here in a moment. So what is this Federal Reserve structure? I often get questions, how are we organized? How are we structured? So this map here highlights the way we're organized across the country. We were congressionally created by the Federal Reserve Act of 1914. And it took almost 2 years before we were actually established here like this. So fun kind of historical fact, 37 cities had applied to become a regional district. We are here, San Francisco, the 12th district. And as you can see, we represent the largest by geography and also by economic output. We represent 6 locations. So as I said, we're the largest of the 12 districts, 9 Western states, 3 territories, we have 6 regional executives, you'll see here, 4, and then 2 cash processing centers. So Phoenix is our large cash processing center. We also have one here in Seattle, Salt Lake City, San Francisco, Los Angeles. We also, interestingly, represent 80% of the country's federally recognized tribes, and they're located here in the 12th district. Seattle, in fact, actually represents the largest by geography branch within the system. So there are 24 regional branches. Seattle covers Washington as well as Alaska. So quite a large territory here. As I mentioned, we do account for 23% of the US economic output. Now, oftentimes people say, you know, in 1914, obviously the country looked very different. The epicenter of the economy was actually east. We have two reserve banks in Missouri, St. Louis and Kansas City. And that had a lot to do with the way the country was organized back then. Today, different. We are also 21% of the US population, and we represent 37% of the US geography. So how do we essentially serve our economy and the communities? You know, in order to do our work, and in a moment I'll share with you kind of our path to monetary policy, we rely on the community. We rely on our branch board directors, our head office board of directors. So a little bit about how we in San Francisco are structured. We have a head office board comprised of 9 members of the community. We have members of banks. We also have banks who vote in on our members. And we also have business leaders throughout the entire 12th district serving. And they're actually our governance body. So they hire our president, our first vice president, and advise on governance and auditing issues. And then we have our 4 regional, kind of our branch boards. And each of those is comprised of 7 members of our community. And this gives you a nice snapshot of who our current Seattle Board of Directors are. Some are appointed by our Board of Governors in DC, and some are appointed by our head office board members. So this gives you a nice snapshot. And we do have a member from Alaska here, Gabe Kromkoff. So we also rely on advisory councils. These are really critical groups who help assist us and advise us on matters of the economy, advise our president on kind of how, like at the micro level, we're seeing the regional economy. And we have 3. So we have our Community Advisory Council. And interestingly, these are members representing economic development corporations, not-for-profits, and our CDAC, which is our Community Depository Institution Advisory Council, so comprised of banks, community banks, credit unions, and then our Economic Advisory Council. Again, broader members of the business community, often, you know, CFOs, CEOs, senior leaders in various organizations representing manufacturing, agriculture, retail. And together we meet a couple of times a year, and they provide just guidance, observations, and insights into how they're seeing their industry, how they're viewing the broader economy with regard to hiring, consumer demand, supply chain issues. So they're really critical in helping us better understand our regional economy. So what do we do? Again, we work on a variety of issues, as I mentioned earlier: resiliency of our payment system, strengthening our financial institutions, monetary policy. And within those, we have our supervision and credit function. So 400 plus financial organizations. We provide educational programs and conferences to support their work. We have cash services. So critical. We don't print money. There's always a myth that the Fed is printing money. We don't do that. But we ensure that the money that is being circulated is fit. So, you know, making sure that it's not crumbling. We ensure that banks are able to have enough access to cash every day. And we really are, you know, one of the interesting things shared with me a while ago from a member of the communities, they said to me, you know, Christina, right after, you know, in times of crisis and emergency, right after, you know, your firefighters, your law enforcement, the Fed is there as kind of that, you know, responder, you know, ensuring that people have access to cash when they need it. And as I mentioned, we do have our processing centers, and one right here. And our processing center in Seattle supports Oregon, Alaska. And so, you know, we are here processing cash. It's a really interesting operation. And we certainly are open to having people come in and observe and take a tour of our facility. And then we do a lot of research on cash. Several years ago, we organized our cash services across the Federal Reserve and have now what's called the Federal Reserve Financial Services organization. And some of you may be familiar with FedNow. So really looking at how we innovate in the cash space, really understanding cash circulations, trends, so that we can stay ahead of the curve and ensure that we're meeting the future appropriately. And then, of course, economic research. We are constantly publishing. We have a team of researchers looking at various topics and subjects within the economy. Last year, we launched something we're really excited about called the Emerging Tech Economic Research Network. And this is really looking at how we're exploring AI, Gen AI, machine learning, and what that impact to those emerging technologies, what that impact will be to the labor market. So, what does it mean for jobs? I'm sure all of you are either using some form of AI, talking about it, thinking about how to integrate it into your business. And this is something we're super curious about, and we convene roundtables regularly within different industries to understand what are those implications for the broader labor market. And then lastly, and this is where I come in, public engagement. We cannot do our work without understanding how our communities are doing. So while we talk, obviously big picture, the macro level around how the economy is doing, we know that it's a very local, it's a local experience. And the way things are, the way the economy is being experienced in Washington can look actually very different from the way it's being experienced in Alaska, in Hawaii. So being kind of on the ground, meeting with community and business leaders every day to really understand that, we take those inputs and then we provide it to our president, who, when she's at the FOMC, is really looking at those regional indices to better understand and formulate monetary policy. And then just to kind of point out here on our educational programs, one of the things we do every year is called our State Small Business Credit Initiative. And this is really important to us. We survey small businesses, companies with 500 or fewer employees each year to really understand what are those headwinds, opportunities to accessing credit, to expanding and scaling their business. And we take those survey results and publish them each year. And we do have a report from Washington. I'm happy to share. It's available on our site. But we really rely on small businesses throughout Washington to help us understand what those challenges are. So as I mentioned, inputs to monetary policy, we have several. Obviously, we're the Fed. We have a lot of quantitative data. We are not short on that. We have economic analysis. We have our boards and councils, as I referenced. We have something called the Beige Book. If you're not familiar with it, I'll show it to you here in a moment. And it's published several times a year, and it really takes the aggregate view of how we're doing in the economy from different sectors in the economy, and how they're experiencing, as I said, consumer demand, labor, input costs, supply chain issues. And that Beige Book is created through the inputs from various leaders and businesses within our community. And then lastly, our network. We love being here. We love meeting and connecting with communities to, again, tap into their observations and really understand, how they're experiencing the economy. So again, this path to monetary policy, it's community engagement and it's economic research. As I mentioned, while we have the dual mandate, our tools are limited. We work with the federal funds rate. That's how we're able to really support monetary policy. But with those limited tools, we really need as many inputs as we can to ensure that we're doing that job well and sensibly. And then we take that information, we give it to our president when she goes to the FOMC. And then at the FOMC, so this mysterious, some of you may think, what is the FOMC? The Federal Open Market Committee. It's comprised of the 7 Board of Governor members. So those board of, Chair Powell, they are appointed by the president. The chair serves a 4-year term. The 7 governors serve 14-year terms. And then each president of the Reserve Bank, so the 12 districts, are also on the FOMC. 5 of which, those they're rotating, have voting power. And last year, President Daley was a voting member. And then our policy and action, right? So again, the goal is we're very steadfast on ensuring that we are meeting our goal. And it's been, an interesting ride. And we'll here in a moment, I'll share with you a couple of slides on where we are with the economy. So recent economic developments and the outlook. So often we get the question, talk to us a little bit more about this dual mandate. I don't really understand. And why 2%? And that's a question, we often ask. We landed on 2%. The Federal Reserve landed on 2% historically because it was where we felt that it was enough. It gave us enough latitude so that consumers and businesses weren't kind of actively thinking always about prices and inflation. It gave enough wiggle room to ensure a healthy and sustainable, path to growth and economic growth. And so it is, where we landed is where our target rate. Often, you see like, why not 1%? And we found that, really low inflation can suppress wage growth and limit spending, right? So if it's too low, people aren't, businesses don't feel they have the pricing power. You won't see wages increase, and then therefore people may therefore not spend. So these are two recent, I just wanted to quickly show these to you on the unemployment rate and the PCE inflation rate. So the PCE inflation rate, the personal consumption expenditure rate, it's the kind of the preferred Fed rate. And I'm sure Hart and James will talk a little bit more about this, but just wanted to share with you where we were in July of 2022. So we were kind of at the peak there, with headline PC inflation, close to 8%, well above our 2% goal. Unemployment down 4%, kind of the average. And you'll see today, so we look at these various kind of sectors within the inflation. So metrics, food and energy, core goods, core services. When we say core services, excluding housing, we know that, housing inflation has its own set of challenges. And some of you, we may hear from you today about what some of those are. We know we kind of take away food and energy because they're typically volatile. And so you'll see today, well, actually, October of 2024, we're still above 2%, slowly making our way, to 2%. And it's been a bit of a bumpy ride. And so, we do still remain very committed to, and you will hear Chair Powell continually talk about this. We are steadfast in our goal and ensuring that we are achieving that 2% target. So with that, I wanted to just, first of all, thank you, but also kind of share with you two bits of fun kind of news from our site that if you're an economics junkie, if you love, kind of exciting your friends with interesting data statistics, I wanted to draw your attention to two things you can find on our website. One, we've just released a new data page on regional indicators within the metro areas. And what's exciting about this is, you're kind of seeing in real time, like at the micro level, how our community, so for example, you'll see Seattle, how we're doing with targeting inflation and with unemployment. And so you can find this, and you'll see here that again, December of ending last year, we are still above 2%, but comparatively, you can see how we're doing compared to our other metropolitan areas within the 12th district. The other point here I'll note is our Data Explorer site. So this is something, again, for businesses out there, individuals who are curious. We draw these, as I mentioned, we have a lot of data, quantitative data, and we draw that data in from the Bureau of Economic Analysis, the Bureau of Labor Statistics. You can go in and play around based on geographic breakdown, point in time, put in your kind of what you're looking for, your metrics, refine your selection, and you can actually get tables and data to show where we are with the labor market, how we're trending with inflation data. And this is updated monthly. So this just gives you some additional information, particularly as a business. If you're curious about, as you're doing business strategy and planning, this gives everyone in the public an opportunity to come in and really, kind of play around with the data to learn more. So with that, I don't know, Ray, if we're taking, I guess we'll pause on questions and I'll turn it over to Hart and James.
Very good. Gentlemen?
All right, we'll jump in. James, I'm assuming you'll let me know if something goes wrong with the screen. And James will be watching chat. If you feel like interrupting us, we're more than happy to have that happen. Christina, thank you very much for that context and background. We'll reference that as we go along. We want to start with some numbers from Blue Chip Consensus Forecast. Not to get into the weeds because we want to get to Snohomish County as much as possible, but just starting, the colors show revisions, either revisions in the sort of the red, the wrong direction, or revisions more to the green since the prior Blue Chip forecast, or in the last column, some of the forecasting work that we do. The main point I want to make with this slide is all the numbers look fine. GDP growth slowing, but really slowing to trend or just below. Unemployment staying low. Inflation, as Christine said, moderating. Not getting to the 2%, but at least heading in the right direction. And the point we want to get to is the headline numbers can be misleading. So we want to try to get behind that. And I apologize for this very wonky slide to start because it's got mortgage rates and a couple of different treasury yields, bond yields. The point I want to make is that whether we look at the returns on the 2-year treasury note or the 10-year, we're back in the 4.3 range with mortgage rates still in the high 6s. And a lot of the forecasts that you'll read about are essentially assuming inflation continues to slow, so interest rates can come down, and no one knows what's happening in Washington, D.C., so we'll just play a wait and see game, and rather than have forecasts for a half a dozen different scenarios, it's just based on what we've seen over the last few years, and that's been very strong consumer spending, inflation trending down with interest rates slowly following as you would expect. If you're of an opinion that interest rates really can't come down because inflation is going to be stickier than expected, in part because of tariffs or something else, then you need to modify your forecast, your national outlook.
Hart, isn't that the point though? I mean, you called it wonky, but we all have to start getting a little more wonky, because if we just look at the median, the averages, and that basic chart that you kicked out at the beginning, you lose the important substance, which is none of us are average, none of us are median. And so all of our experiences are different and unique. And so when you hear people railing about, oh, the economy's terrible or the economy's fine, their economy is fine. Their economy, the way they're experiencing the economy.
Yeah, and Christina was already mentioning what we feel in the economy in Washington is very different than Hawaii or someplace else. And that's going to be one of the takeaway messages for sure. This slide, again, the general metrics. If we compare what's going on in Snohomish County to some of the surrounding counties, and we look at poverty metrics, we look at housing population or demographics, everything looks fine. And we all know there was a bit of a vibe session. If there wasn't an official recession, people certainly thought there was one. And you want to know why. Was it just social media, or is there something really going on in the numbers? And as we dig into that, I think we're going to tell a story of the metrics look fine, and I'm a little worried. And we're going to point to some tenuous elements. So you have to bear with me. I'm going to bounce back and forth a little bit because sometimes we can talk about data for Snohomish County itself. Other times we look at data and Snohomish is lumped in part of the Seattle metro area. So this is for Snohomish County, and we just grabbed 7 or 8 different sectors. So this is not the entire economy or all of the sectors that matter. What we're trying to show is that in Snohomish County proper, 19% of the jobs are in manufacturing. And you have to keep in mind that nationally and even at the state level, less than 10%, closer to 8% of the jobs are in manufacturing. So we can talk about changes over time, but health and social services, government, you've got quite a bit of the workforce just looking at those 3 sectors. So keep that
Hart,
in.
when you say government, are you talking about the planning department at the county? Because I'm sure that's what most people think of when they think of government, right? What's included in that
I'm
category?
talking about our elected official. No, it's K-12 is always a big player in government. And when you look at a smaller county, and that's not Snohomish, but if you look at Skagit or Whatcom, government is going to be over 15% because of K-12, because of different government offices, and in our region, tribal.
Tribal's a big thing. So every person that works on the Tulalip reservation is considered in the government sector. So when you go to the casino and you're talking to your favorite blackjack dealer, they are lumped into that government category as well.
When we add wages and try to think, what role does a given sector play in the local economy? And you see manufacturing. So, okay, 19% of the jobs, but 27% of the wages earned in Snohomish County come from manufacturing. And so I'm not telling anybody on this call something new here. We know that's important. Government, 15% of the wages in the county. And health and social services, we often think about how much a neurosurgeon makes. Health and social services is not a high wage sector. Most of the people in health, when you start adding in all of the in-home care workers, all of the support staff, so you see that drop in terms of wages relative to employment. So just trying to paint this picture of Snohomish, because as you think about policies and as you think about major trends at the national and state level, you want to be thinking, how will they affect these sort of driving sectors in our area? And it's a very different story if we flip. And so I'm just focusing on wages here, but I'm showing King County, where 27% of the wages in Snohomish County come from manufacturing. It's 5 in King County. Whereas in the information sector, it's 1.5 versus 22. So very different feel, very different job mix.
And very different wages though, Hart, right?
Yes, well, the job mix and wage, average wage for those jobs combined is what I'm really trying to show here with the percent of total. And again, that's going to matter. But I'm setting the stage of Snohomish versus King County, and I really want to back off of that. The Census Bureau works a little bit with some of the other agencies to track where do you live, where do you work, and you have to take these data with a huge grain of salt, because what it's really showing is where have you reported as your primary address and where did your paycheck come from? And your paycheck might say Seattle, but you don't actually commute daily to Seattle. But still, it gives a good starting point for a discussion. And what this map is showing is that there are a little over 132,000 people that live in Snohomish County and go to work in Snohomish County. There's over 99,000 people that work in Snohomish County that commute in. Suppose I commute in from Skagit County. But there are 190,000 that live in in Snohomish County and commute out. With no shock, most of them go to Seattle. But one takeaway message from this slide is you don't want to think about Snohomish County as an economic entity. There's an awful lot of people who live there, who work elsewhere, bring money back. So a lot of those information jobs in Seattle, King County, are filled by people that live in Snohomish County. So that's something to definitely keep in mind. Jumping cost of living. There are different measures. The main measure that we use comes from the Council on Community Economic Revitalization, C2ER, and that group organizes a cost of living survey 3 times a year where shoppers go out, and some of the shoppers are students who participate in these surveys, and they go out with the same shopping list in different cities 3 times a year. So the way to look at this is each survey is packaged and the national average is 100. So the numbers on the left are an index value. So it says that Snohomish in the last round at 126-ish would be about 26% more expensive to live in Snohomish County than the U.S. overall. If you get Yakima is cheaper, Boise is cheaper. Lots of places in the Southeast are a little bit cheaper. I have 2 different numbers. Seattle, they break out for the greater Kent area, but Seattle City, maybe we shouldn't be so excited. Seattle is gaining on San Francisco as one of the more expensive places to live. I don't think this is a race you want to win. Bellingham, Whatcom County, about 20% above the national average. Housing and healthcare are the real drivers behind these numbers. A little bit on the groceries, but the 2 are really housing and healthcare. And this matters because how do you attract workers? I want to grow my business. I want to attract workers. Housing is expensive. How much do I have to pay them? So the cost of living really does ripple in, and I'll focus on housing. So didn't exactly get the exact same wage numbers as median house numbers. I'm just using the most recent data that we can get, annual wage from Employment Security, housing from the Real Estate Research Center at the University of Washington. So average wage, about $76,000 a year in Snohomish County, $786 for your median home. If the person earning the median income could afford the mortgage on a median priced house, and by afford having no more than 30% of your income go to housing, the affordability index would be 100. And in this case, the lower the number, the less affordable housing is. So King County, you've got an affordability problem, and again, really basic pattern that everybody understands. If housing is more affordable in Snohomish County, I know that residents of Snohomish County don't think about housing there as being terribly affordable, but if I'm earning the median wage or the average wage in King County, housing looks pretty affordable to me in Snohomish County, and you start to see the drivers of those commutes. Whatcom County and King County, these affordability numbers bounce around. Every time the Research Center puts in the latest income and housing numbers, so sometimes King County is less affordable in terms of that index than Whatcom, and we all bounce around. We have an affordability problem. We have a housing supply challenge, and that pushes us into a lot of different sectors. When we look at job growth pre-COVID, and I just looked at 2010 to 2019, 3% growth. It slowed a little bit, but we're still over 2% growth. And now I'm lumping Snohomish in with the greater Seattle metro, Snohomish, King, Pierce region. One thing that is important is that the main sectors that were driving employment growth from 2010 to 2019 were the information sectors, the professional and technical services sectors, very different from what we're seeing now. But if we look at just the headline numbers, hey, unemployment 3.2%, you got to feel good about the economy. And this, James, this is where you were saying, let's back up, let's get wonkish, let's think a little bit more carefully. The unemployment rate is the number of people looking for work divided by the people that are working and or looking for work. If I've given up, I'm a 60-something-year-old guy and I can't find a job and I've stopped looking, I don't count. I'm not part of that 3.2%. And there's nothing in that headline, and there's different measures of unemployment, and we're just going to focus on the typical, most common headline number. There's nothing in that number that talks about type of job. So we might have lost some manufacturing jobs, added some retail or some other jobs. Maybe the unemployment rate doesn't change, or maybe it goes down. And there's nothing about, oh, we've lost those high-wage manufacturing jobs, we've gained low-wage leisure and hospitality jobs, and things don't feel as good. The headline metric says they're just as good. I might be working part-time. I'd prefer to work full-time, but I can't find a good full-time job. There's no adjustment made in the headline numbers, at least, for that sort of quality of job. So I think what we're trying to say is get wonkish. Go to those data sources that Christina was showing so you can drill down, understand what's driving inflation or not, understand what's behind the headline unemployment numbers, because they can be that can be important. So I'm back to Snohomish County here, and I'm just trying to show employment growth in, say, 8 sectors, because what I'm trying to show is in recent years, for the last 2 years, almost all of your growth has been in leisure and hospitality and government.
Which has been not atypical though, right, Hart? I mean, we've seen that in most counties.
It's starting to be common, but isn't that part of the vibe session? If we're laying off people in the information sector making $300,000 a year in Seattle, or if I'm laying off people in the manufacturing sector in Snohomish County who are making over 100,000, and I'm replacing them, I have the same job count because I'm hiring people in leisure and hospitality, but those are 30 and 40,000 per year jobs. Things don't feel as right.
So there's 2 points, Hart, that I want to underline for the audience. The first thing is that sometimes the unemployment number also gets skewed because when people get a severance package, I'm going to pick on Microsoft, for example. Microsoft says, hey, we're going to lay off 3,000 people out of our sector here, but we're going to give them a 6-month severance package. They don't show up in the unemployment data until that severance package runs out. And so if they find a job before that 6 months runs out, it never impacts the unemployment data. So we've seen pretty large transitions happen within the information sector without large changes in unemployment in information sector. So it's been interesting from a data perspective. And that's the other thing that the workforce participation number is the other piece to unemployment. So I always like to look at both. I like to look at the unemployment data, but I also like to look at workforce participation because that doesn't exclude people that have fallen out of the workforce. As long as they're between a certain age, they are counted in that math between either you're employed or you're not employed. And so workforce participation is one of the data sets we look at, and we can look at it by gender or a number of different ways. And that has been declining, but it's been declining for quite a while because, well, people are getting older and we're not having as many kids. And so it's basic math, right? But being wonkish with this data gets to be fun when you overlay the different data sets.
And there's a slide coming up. When you're looking at this one, I'm wanting you to think, what is driving the growth in employment in leisure and hospitality? Think back, because during the pandemic, lots of government subsidy money, payroll protection plan, direct assistance, lots and lots of money pushed into the economy because we didn't know what was going to happen. And it was just an incredibly fast response and an incredibly supportive response from the government and the Federal Reserve. Consumer spending has been the driver for this economy. And as we as I jump back to a summary forecast, just so that we have this, and you look down at the United States, GDP in 2023, 3.9, 2024, 2.7, where everybody was calling for a recession. The consensus forecast at that time was for a recession, either in 2023 or in early 2024, and because consumer spending was supposed to slow. COVID stimulus money was supposed to run out, and so on and so forth. It hasn't.
I was promised 6 or 7 recessions, Hart.
I was cheated out of a recession, and I'm feeling a little bit punky about that. And it may be that now no one is calling for a recession. You might want to be careful. But I mean, again, the point here is these headline numbers all look good, and you've got to get behind them to figure out why things feel tenuous, why consumer sentiment was down, aside from a social media effect. But you really want to keep an eye on those yields that we started with, or the strength of the US dollar. I put those out there because I think you're going to see those acting as throttles, if you will, on different policies and decisions in Washington, D.C., but staying more local. Consumer spending, because if consumer spending slows, and it's been driven by the top 10% of income earners for the last year and a half, 2 years, it's not a broad everybody spending, because a lot of people are struggling with the price of eggs or other things. If the top earners start to slow spending, you're going to see weakness in that leisure and hospitality sector. That's been your driver. That'll be a problem on the labor front. It'll be a problem on tax revenues. And local government has been your other strong economic driver in terms of employment. So I guess what I'm saying is the main numbers look fine. They feel tenuous because if consumer spending slows, if yields stay high, we've got some issues to deal with later this year. There's also proposed cuts to Medicare and Medicaid. Health and social services are your third biggest driver. Those cuts will be felt. Tariffs, if the proposed 25% tariffs on aluminum go through, and I don't know what the betting pool says on whether that'll actually happen or not, but Boeing still uses a lot of aluminum. If they're not, and the high quality aluminum coming from Canada right now, Canada has said with the tariffs, we're sending it to Europe. And the U.S. would have to source aluminum from other places, whether it's Australia or even a joint venture in Saudi Arabia with Alcoa. Those prices are higher. So some of that growth is that we've enjoyed is tenuous, and there are some real risks that are not evident in the major headline outlook. So I'm not trying to be overly negative, but we need to be attentive to that. James, I'm going to skip over our thank yous. Rachel and Ray have our contact information. We're happy to be a data source along with Christina for all this on some follow-ups. Where'd you get the data for that graphic that I saw? We're available for that. I hate this slide, so it's all yours, James.
We post out 6 to 8 things every day on social media. So if you like charts, if you like news stories, we're a great source. We get asked all the time, what do you guys read? We post it. So check it out. You will read all kinds of crazy stuff. Sometimes it's stuff we don't agree with, and we'll talk about why we don't agree with it. We also put on a little show. We have a podcast. We do 4 or 5 of those a year. Hart, you showed the summary forecast out of the Puget Sound Economic Forecaster. So we do a podcast about a month after we publish our forecast, and we talk about further information about what we've published, or sometimes changing what we published. So that's all out there in the universe, and you're welcome to consume all those things. And the forecaster is a subscription product. We haven't changed the price in 30 years because we're terrible at math, evidently. But that it's a great way to, again, get regionalized data as well as county specific data. Ray, we're 2 minutes over, so we'll have to pay a little extra.
Well, thank you both, Hart and James and Christina. I know Carl has a question. I'm going to read it in a minute, but there's one piece of legislation this year that's very concerning to economic growth, and that is legislation that would provide unemployment benefits for striking workers. So with three economic experts, anyone who wants to share their opinion about that or concern about that, I would appreciate it.
I would go back to the cost of living slide. We're already expensive. Labor is expensive, and there's a lot of employers that feel a distinct squeeze. The easiest sector for me to point to is healthcare, where government is trying desperately to reduce spending on Medicare and Medicaid. That's the revenue for hospitals and healthcare clinics. Labor costs are going up, and when you add in expenses related to paid family leave and if you now go to additional benefits for unemployed workers, and what happens with the swings in manufacturing, I mean, that you can think of in Everett in particular, it just gets very challenging. And I don't want to say that I don't care about workers. That's not true at all. I just think it's challenging because you want to help workers. You want to help workers who are having to deal with really high housing costs and other expenses in the region. But I don't know that the business community has been able to weigh in on that properly.
I think the wonkiness of it, Ray, complicates it too, right? So unemployment for a lot of people is just this magic pile of money that just gets paid out, right? Well, it comes from the employer, right? It's part of the compensation package of how a company thinks about how much they're willing to and able to pay an employee. So if unemployment costs more, so the taxes to subsidize unemployment goes up, on the experience factor goes up, then those companies at the end of the day are going to have to pay less because they only have so much money to pay. But from an employee's perspective, they're like, well, if I'm not being treated in a way that's fair and in the marketplace, well, now I'm being double punished. So the answer is no one wins in that situation, right? No matter which way the vote goes in Olympia, someone's going to lose. And so I'm like, well, is there a third option? Is there another way to think about it? Think about the problem. You know, some unions have strike funds that they pay out. They look at other ways. So are there other ways forward that might actually make it a more balanced equation?
Christina, do you have a thought about it?
Well, first, let me say, and I, was remiss in not leading with our standard disclaimer. So, I am here. I know James is laughing for this. All of the opinions you hear from me are mine alone and do not reflect the Board of Governors or anyone at the Federal Reserve Bank and the Federal Reserve Bank of San Francisco. So, just want to make sure that that's very clear. All I can say and is really just kind of reflect what I'm hearing in the community. As I mentioned, our role is, we're very squarely focused on our dual mandate as our tools to bring down and combat inflation. And there are, and we, look at a multitude of data points. What I am hearing though, and from as I'm out in the community talking with different leaders across the state, there are certainly concerns. Just yesterday I was at a meeting and, there were business leaders talking about the cost of doing business in Washington state. And what does that mean and portend for the long-term growth of our state? In Washington, our unemployment rate is 4.5%. So how are we, there are businesses, small and large, looking at ways to we import a lot of talent and looking at where we can also hire outside of the state. So I think as James and Hart noted, there are a lot of these considerations and certainly, fiscal policies will impact even at this very micro local level, how governments are responding.
Ray, we get asked to weigh in on tax issues. We get asked to weigh in on housing issues. And a lot of times we have to reframe the conversation because people get really narrow on things. They say, well, alcohol costs too much in Washington State. I haven't heard this one in a while, so that's a good example. Alcohol costs too much in Washington State because we have such high taxes. Taxes are lower in California for alcohol, so we should be more like California. But nobody wants to have an income tax like California. Nobody wants to have property taxes like California, right? Like, you have to when you talk about taxes, you have to talk about tax per capita from when you compare state to state, because every state has its own tax scheme, which sounds naughty, I guess, but everyone has their own tax way they tax their folks. So you have to look at tax per capita, and so you have to do the same thing if you want to look at issues like unemployment and what does it cost an employer. Well, what are the employment costs, and how does that relate on a per capita or some basis to unpack that so that we're actually comparing apples to apples. Because it's really easy to say, oh, Washington State, so we have a B&O tax, it's terrible. Well, but we don't have an income tax. And so when you look at tax per capita, we're in the bottom third to bottom half, depending on which study you want to look at across the country, right? So over half the states have a higher tax burden on their population than we have in Washington State. But we like to talk about how our taxes are so high in Washington because we cherry pick which ones we're going to look at. And that's again where you gotta get into the complications of this to really understand it, to have a better conversation.
Yeah, for those of us who are in the job growth business, I worry about the unintended consequences of a unemployment tax. We may not feel it right away, and the legislation may feel good in some sectors, but when we're out there trying to hustle jobs, and really to Carl Saporal's question, we're seeing municipalities trying to increase their property tax from the level of 1% to 2%. Public safety initiatives that have gone out, port expansion initiatives, and the voters are saying no. I mean, pretty strongly. So, it for me and for my staff and the people who are about job growth, we see that as our salvation, and anything that inhibits that is of a concern to us.
I want to jump in. I saw a question in the chat, or just a comment in the chat, that things feel this entire cycle feels different. We've had the longest inverted yield curve ever with no recession. My first reaction is we also had by far the largest injection of cash into the economy. So that changed this cycle. And a surprising boost in worker productivity. So earnings were better, but income better. So I think the cycle was different in a lot of ways, and and no single predictor is always accurate. But I also might say, be patient. Yeah. So anyway, I digress.
One thing just to jump in, and you can see this in more detail in our January publication of the Beige Book, but in our district, we saw, good economic development and economic growth. I mean, we saw wages slightly increase, unemployment levels, stable, large consumer demand at year end, retail spending was up. And so, I would be curious from the group, if you want to put it in a chat, kind of turning this table around, how are people here? I mean, you represent small businesses, government. How are you feeling about the economy, going into now 25? And, what are some of those headwinds that you're concerned about or navigating?
Christina, we often joke about what we hear from people is, I feel okay. I may be a little concerned, but I feel okay. But I'm really worried about my neighbor.
Yeah.
Right.
And yes. Yeah, I feel great about the economy. Right. But it's not going well.
No, and we have data sets, and Ray, I mean, obviously we can't bring all of our cool slides, but we have data sets that, where surveys have been done that ask people how they feel about their local economy. And Hart helped me out. It's like 70% feel like their economy is doing at least okay or better, or maybe it was 80%. And then you ask, well, how about your region? How's your region feel? And it's like 20% lower. How do you feel about the national economy? And it's like 40% lower. That's not statistically possible. Like, it's not possible that when you get a national sample that everyone says they feel good about their region for the most part, but then they're really concerned about the national economy because you've surveyed the nation on a regional level, right? And so it's, and I sometimes, is it possible we're being marketed to in a way to get us to talk about the economy and have certain feelings in a certain way rather than looking at, taking the time to really dig into the data to unpack it and just focus on us being worried about our neighbor.
Yeah. Well, you know, I can tell you too, I hear an awful lot about the cost of housing, trying to purchase housing. The average price in Snohomish County over 800,000. One of the economic benefits that I've seen to that is a significant growth in Snohomish County of apartments and multifamily rental property. And I think that the dream of home ownership, I know it still resides with a lot of folks, that's important. It's a lifelong investment, but you know, renting is certainly a positive alternative, I believe.
Well, and you have to dig into, I mean, from the history of when did homeownership become the American dream, and why did that? What was the underpinnings of that, right? What caused that to become our mantra, so to speak? Because we have a much longer history as a country of renters than we do as owners. Owning it's the idea of it being the American dream is not that old in all reality on the larger scale of things. But you're right, and Hart and I sometimes joke, and we're kind of I'll pretend all of you are very smart people and won't see this the wrong way, but homes have never been affordable to everybody. Like there's always been a portion of full-time employed people that home ownership was not affordable for. But then that also gets us into a problem of median and average, right? No one earns an average wage. Nobody buys a median home. So in the same market, I find an $800,000 home. I might be able to find a $400,000 home. Is it the home I want? No, right? But it's the home I can afford. It might not be in the right location. It might not have the right things. And so we get into these discussions sometimes with some folks around, well, what does that mean? Like home ownership. What are we talking about? We're talking about a 3,000 square foot bungalow, or are we talking about a two-bedroom, shotgun type home?
But James, I would weigh in that we should not think about our current housing shortage, crisis, whatever words you want to use, as something that has just emerged. This has been building for decades and decades, and the housing market. Some people say markets are failing, and market's doing exactly what it should do, can do. A market is not going to provide housing for people who can't afford $250, $300 a square foot. I mean, it's a tricky problem of where have we seen income growth? How has that growth been spread? Not evenly. Growth Management Act, zoning, there are a lot of things that come into this. And I think where you're going, James, we don't really talk about a slow growing problem of what do we do about housing? If we've got a number of our workers earning $30,000 a year, $13 an hour, whatever it is, they're not going to be able to afford that 3,000 square foot bungalow. And we haven't had a conversation about what type of a housing, affordable for whom. We've pushed it down, and here we are.
So I want to keep us on time. So I want to thank Christina, James, and Hart for sharing your insights today. This conversation has provided valuable perspectives on the economic trends shaping our region and key factors that businesses should be paying attention to in 2025. Special thanks to our sponsor, Herald Media, for the event today. Before I go, I want to invite you to the next coffee chat on March 25th. We'll be discussing the green economy, opportunities and challenges for our businesses, and we'll explore the economic impact of sustainable practices and emerging green industries. Mark your calendars for April 22nd. That's the Economic Alliance annual meeting. I hope to see you all there. And before we conclude, if you have a coffee cup or beverage of your choice, I want to salute all of you and thank our panel for being here today and supporting the Economic Alliance.
Thank you so much.
Thank you. Have a good day.